Over the last month, the S&P is up 4.5%, and when we take a look at the heat map, we can see the majority of companies did very well. In fact, some of them, like Apple, are up double digits, and we have some very bullish news for the month of July. As we can see, it has been up 9 years in a row for the S&P, and over the last 10 years, we can see it is higher 90% of the time and up 3.1% on average. We can also note that since 1928, July has emerged as the best month of the year on average in terms of the stock market performance. So today's episode, we are focusing on 5 undervalued dividend companies. The first one we are looking at is Visa Incorporated. Now we do get a double buy from Seeking Alpha and Wall Street, a hold from Quant. It is trading now in the midpoint of the 52-week range as it has cooled down just over the last month. In terms of forward yield, well, 0.79%, and in terms of a forward P, 26.35. S&P right now around 22, 23, but bear in mind we'll compare it to the sector P for relevancy. Over the last 12 months, it is up around 15%. Over the last 10 years, it is up very strongly, 391%. Also bear in mind, this company has significantly outperformed the S&P during the same time. Now, in terms of dividend safety, well, a 99 score, so the highest score obtainable. Market cap just over 500 billion. It is a mega cap company, and when we take a look, it was reaffirmed last month that essentially the very safe score means that a dividend cut is highly unlikely for this company. In terms of the recessionary metrics, for those that see one inbound, well, they increased the dividend during the Great Recession 07-09. They also had plus 9.5% sales. That was above what the average was for the S&P, which was in fact negative 12%. In terms of dividend growth, well, one of the reasons we do love Visa in general, double-digit increase last year, double-digit increase over the last 5 years, and a strong 18% on average increase to the dividend year on year. We also note they have been increasing those dividends consecutively for the last 15. In terms of dividend yield theory, as always, it does state a company is undervalued when the current yield sits above the 5-year average. So we have not just one undervaluation signal for Visa, but a double undervaluation as it is below the forward P of the 5-year, 25.1 in today, 28.9 as the average, which is rolling. In terms of the sector P, well, financials does sit much lower at 11.3, but we do believe Visa is a high quality company, as we're about to see, that does warrant and justify it trading at a premium. In terms of the free cash flow payout, we want to see below 60%, give us confidence that they are able to continue offering those double-digit increases, and over the last 10 years, pretty much it has been below 20%, 19 in the more recent year for 2023. In terms of free cash flow, we want consistent growth year on year, 266 in 2014, 962 in 2023, so we can see here very strongly more than tripled over the last 10 years, and anticipated to continue in that upward trend, 1060 over the next 12 months. When we do our deep dives on this channel, we want 3 to 7% growth year on year. For Visa Corporation, pretty much double-digit increases every single year, other than that justifiable COVID year of negative 5%. We then move on to their sales, 12.7 billion in 2014, and as we can see, nearly tripled it over the last 10 years. And what we do quite like is when they return excess cash to shareholders, to investors through those share buybacks. As we can clearly see, they consistently do that year on year. In terms of the ROIC, very important metric, 10% or more, give us faith management are able to effectively allocate their capital. Absolutely phenomenal year on year, and 34% in the more recent period. Definitely makes it very attractive company for potential investors. Operating margin not only above the minimum 12%, significantly high, consistently, and in fact increasing over the longer term, 67% over the more recent year. And we can clearly see free cash flow margin in the low 60s over the last 3 years, well above that minimum 5%. We then take a look at the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. This essentially correlates to both dividend safety, balance sheet strength. Below 3 is what we want to see, and this number here represents the number of years it would take the company to pay off all of their debt net of cash on hand. 0.05 in 23, 0.11 over the next 12 months. Very strong balance sheet, no issues whatsoever with that dividend. We then move on to the valuation of Visa, and as always on this channel we do our deeper dives. We run through every single one of these models, getting to our intrinsic value. Today's episode, we're going to jump straight into the model, and if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the intrinsic value, $318, as we can see, margin of safety is something we always use. We start off with 10% and execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that today for Visa, well, it is a buy at $286, then we keep going to see what essentially MOS level we are looking at today, and we can see it isn't quite at that 20% level yet. It is sitting right now at just over a 15% margin of safety, up to around $270. In terms of Wall Street and their expectations, well, they see the share price pretty much in line with our intrinsic value over the next 12 months, giving them around 21% upside. As always, let us know your thoughts about these stocks as we do run through them today. Now, before we do move on, just to let you know, we've released our latest free weekly article where we run through 10 undervalued companies with phenomenal balance sheets. If you want access to this or any other articles, all completely free, do click on that pinned comment below. You can start reading straight away, instant access. The next company we have is Automatic Data Processing. Now, we get 1 buy rating from Quant. We do know a double hold from the other 2. It is trading in the mid to upper end of the 52-week range. It has a higher yield than Visa, 2.35%, and it does have that forward PE, 26.09. In terms of its performance, well, over the last 12 months, it is up around 11%. Over the last 10 years, not only up 236%, but it has also outperformed the S&P over that same period. We get another very safe dividend score, 97, market cap, well, just under 100 billion, another large cap company, and we can see that dividend safety score was reaffirmed last month. In terms of the last recession, well, they increased the dividend, they had above average growth, and they also significantly outperformed the S&P, negative 29 versus the S&P's negative 55. Dividend growth, well, another one which is double-digit increase their dividend over the last year, over the last 5, and over the last 20 years. We love to see that. And on top of that, a bonus for this company, they are 1 year away from getting that all-exclusive Dividend King status. We then move on to dividend yield theory. No surprises here. We have a double undervaluation signal, both on the yield as well as that forward P, and we can see it does sit higher than the industrial sector P of 19. But as always, when we do our deep dives, we do come to understand that the majority of these companies are very high quality, and within the sector there are a lot of companies that are in fact very poor quality. In terms of the free cash flow payout, below 60% is what we want to see. Consistently, in fact, it has been around that level. Nice to note 55 in 2023. Anticipated over the next 12 months to drop down to 42. In terms of the free cash flow payout, well, more than doubled over the last 10 years, and again we can see over the next 12 months this is expected to continue in that upwards trajectory. We then look at the sales growth, maybe not as fast as Visa, but we still see around that 3 to 7% as a bare minimum, 9% in the more recent year, looking very good, and we can see they have increased their top line 80% over the last 10 years, as well as also doing some share buybacks, which is a very big positive for investors as a whole. In terms of ROIC, again, absolutely phenomenal. We are trying to bring some very high quality companies to your attention. We can see 64% in 2023. Margins also absolutely gorgeous. Again, remember, not just above the minimums, we also want to see consistency and operating efficiency, which is clearly what we get here over the last 10 years. And free cash flow margin, again, consistency and very strong at that level. Finally, the net debt to EBITDA, again, similar to Visa, a phenomenal balance sheet, 0.28 in 2023, expected to come down to 0.02. So again, do take note of these very, very strong quality companies. In terms of the valuation model, and don't forget you can click on the pinned comment below to grab a copy and run your own numbers through or for your own companies. Intrinsic value coming to $271, current price $238. With a margin of safety at 10%, we do see it as a buy up to $244. At 15%, around $230. So this could be one that you do have on the watch list over the month of July for around that $230 level. But for those who are seeking, in fact, a larger MOS, at 20%, it would be around $217. So in today's episode, it is sitting between that 10 to 15% level at $238. In terms of Wall Street and their forecast, well, over the next 12 months, they see upside, although they only have 10% at a price target of $261. We then move on to Salesforce, where we have that double buy rating from Wall Street and Seeking Alpha, a hold from Quant. Now, it has recovered from the drop after the earnings, which we covered not too long ago. Right now, sitting in the midpoint of the 52-week range. Yield on a trailing 12-month at 0.16. Forward P at just under 26. Over the last 12 months, well, up 21%. Over the last 10 years, again, another outperform of the S&P, up 339%. Now, given they have just started to pay a dividend, we don't have that score. We can see market cap 249 billion. It is a mega cap company. And when we do take a look at that payout ratio, what we can see here is over the next 12 months, it's at 13%. This is a very strong sign because to me, it indicates they will be able to increase that dividend at a very rapid rate. Free cash flow also looking absolutely incredible. Remember, this is what you want to see from any company you're considering. It might even be worth taking a look at this at companies in your own portfolio. Sales growth, one thing we would say, it has started to slow down. Whether or not you do believe that will continue, that may be something to factor into your own due diligence, as well as essentially your margin of safety. Nonetheless, double digit every single year, and we can see they have increased that essential top line 7 times over the last 10 years. First company today then that have actually essentially issued a lot of shares, so they have diluted your position over the last 10 years, something just to take note of. And the ROIC does leave a little bit to be desired for 8% in 2024. Remember, we ideally want to see 10% as a minimum. Operating margin as well, pretty questionable over 9 of the last 10 years. Nice to note 2024 at 17%, so above the 16 minimum. 18% on a trailing 12 month, and free cash flow margin also looking very strong. It has been increasing over the longer term, 32%, again very attractive over the last 12 months. 2024, something that neither Visa or ADP managed to accomplish, a 0 on the net debt to EBITDA, indicating it wouldn't take this company one day to pay off all of their debt net of cash on hand. So let's jump into the valuation. Now for this company, we only see it as the DCF model being relevant, and it does come to $321. Now how we got to this, essentially we put it through the DCF model. When we did our deep dive, we ran through a low, medium and high rate. We went with the medium rate, so you are understanding where our value at today is coming from at that 10% level. If you believe that over the longer term, that will be the increase to their free cash flows. That is therefore the intrinsic price. In terms of margin of safety, at 10% then a buy up to $289, at 15% at $273, at 20% pretty much bang on the current trading price. So for Salesforce, in today's episode, we see a 20% MOS level, with Wall Street indicating 18% upside over the next year with a $304 price target. We then move on to the Hershey company, where we actually have a double buy rating, although the hold is from Quant. The first one now that is trading at its 52-week low, with the yield now sitting at 3% and a forward P 19 below the S&P. Over the last year, down 26%. The rise in cocoa prices has really hammered this company. Over the last 10 years, it is up around 91%, and we do see its all-time highs around a year ago at $275. Nonetheless, dividend safety score 80, it does look to be safe. Market cap 37 billion, a large cap company. Now we can see it was reaffirmed, that safe score. Now safe essentially means a dividend cut is unlikely. And when you look at the last recession, well, in fact, they maintained the dividend. They had flat sales, but that was above the average. They also outperformed the S&P, negative 30%. Again, another company, double-digit increase just this February at 15%, as well as over the last 5 and 20 years. And we can see not only increased the dividend for the last 14, they have paid a dividend for the last 94 without a reduction. In terms of dividend yield theory, well, this looks severely undervalued. This is the highest yield they have offered over the last 10 years. And we can see here the forward P, 19.3, is significantly lower than that 5-year rolling. And we note it isn't too far off now the consumer staples average. When looking at the free cash flow payout, we lift this up to 70% for consumer staples, pretty much below that every single year, 53% anticipated over the next 12. So we would be surprised if we don't get a very strong dividend increase next February as well. Free cash flow also increasing nearly 4 times over the last 10 years. Again, over the next 12 months, this is anticipated to increase and continue upwards. And we do note over the longer term, they are hitting that 3 to 7%, 7% in fact in that more recent period. In terms of numericals, well, they have increased their top line around 50% over the last 10 years. And in terms of shares outstanding, whilst they do share buybacks, it is fairly marginal and inconsistent. ROIC is very consistent over the last 5 years, around that mid 20%. Again, we want to see a minimum of 10%, so that is very positive to note. We can also see operating efficiency on the margins going up from 20 to 23 in 2023, and on a trailing 12-month basis, 25%, and free cash flow margin looking very strong as well, 14% in the more recent year. Now, the net debt to EBITDA below 4 for consumer staples. Now, whilst it isn't as low as the previous companies, nonetheless, 1.49 is still very strong for 2023 for Hershey, indicating a safe dividend as well as a very strong balance sheet. In terms of the valuation then for this in today's episode, it is arriving at a value of just over $208. And when we do look at that margin of safety at 10%, we can see it buy up to $188. At 15% at $177, so in the month of July, this could be essentially your price target if you are very bullish on this company over the longer term. In terms of Wall Street though, what they anticipate, they see around 13% upside over the next 12 months, their price target around the $207 mark. We then move on to the Walt Disney Company with a double buy from Seeking Alpha and Wall Street, a hold from Quant. It is trading in the mid to low end of the 52-week range. It also recently restarted their dividend, 0.3% on a trailing 12-month basis, and the PE 20.87 does sit below the S&P. Over the last year, well, up 12%. Over the last 10 years, very, very poor, just up 14%. We can see it is some way away from its all-time highs around 3 years ago at just under $200. Currently trades pretty much half that price today. In terms of dividend safety, again, no scores, they just restarted that dividend. Market cap, $181 billion. It is a mega cap company. And we can see a negative here because they did cut that dividend during that COVID period. Over the last 10 years, negative 10%. Over the last 20, 2% year on year. And this graph does indicate that massive cut to the dividend during the pandemic. And it was maintained until 2022-23 where it was restarted. In terms of then looking at the free cash flow payout, pretty low, 11% in 23, 18 over the next 12 months. So they do, from what we can see, have that ability to increase it back at a very rapid rate. No surprises, COVID have affected these numbers very strongly. With all the parks, they had to close them down, but we are seeing a nice rebound from 22 to 23, and it is expected to continue into 2024. Sales growth very mixed, 3 to 7%, pretty much what we are seeing on average across the board, as they have nearly doubled their top line over the last 10 years. And whilst they have done share buybacks, they've also issued shares, as we can see the net position over the longer term is share issuances. We then move on to the ROIC. Now again, we do see the decline of this down to the lows in 2020. Nice to note it has started to come back up. This could be argued as a turnaround play, 7% over the last 12 months. Same to be said with the operating margin. If they can improve those margins, that will be very strong for this company. It has rebounded from the 5% lows of 2021, 12% on a trailing 12 month, and the same can be pretty much said for the free cash flow margin, 9% on a TTM basis, and we just want to see a minimum of 5 moving forward. Net debt to EBITDA, as always, below 3 is what we want to see generally, 1.99 in 23, 2.01, so pretty much the same as the previous year, expected over the next 12 months. So the balance sheet does look okay. That dividend also does look safe, even though it is very low, and the free cash flow payout is also very low. Now, what about the valuation of this company? And as always, if you have enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, with a 10% margin of safety with a price at $99, it is indicated a buy at $111. Then we keep going at 15% around $105. And in today's episode, pretty much trading at a 20% margin of safety if you do believe they will be able to turn around this company over the longer term and massively improve those margins to what we saw not too long ago. In terms of Wall Street, well, they are very bullish as well. Their price target, $128. They see upside of 30% as well, indicating it definitely one for consideration if you do believe in this over the longer period. Finally, what we would say with all of these companies that we have gone through, let us know your thoughts in the comments below. But ultimately, if you don't believe that any of these over the foreseeable future, the longer term, depending on your investment strategy, will outperform the S&P 500, you may be better off putting your money in a low-cost ETF like VO that we did see at the beginning of the episode. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and we'll see all of you on the next one.